Welcome to my channel where I discuss AI, technology, and stock market trends daily. Today, I want to delve into a topic that has been generating significant debate among economists, investors, and market analysts: the rapid rise of passive investing through index funds and its potential impact on market dynamics. Specifically, we'll explore whether the increasing dominance of passive investors is distorting the stock market and assess the associated risks for those who continue to invest in these funds. Over the past few decades, passive investing has transitioned from a niche strategy to a dominant force in global financial markets. As of October 2024, passive funds, including index mutual funds and exchange-traded funds, manage assets exceeding $20 trillion worldwide. This growth is particularly pronounced in the United States, where passive strategies now account for approximately 60% of all equity fund assets under management. This marks a significant shift from the early 2000s when active management was the prevailing approach. Several factors have contributed to this surge. The efficient market hypothesis suggests that it's challenging to consistently outperform the market through active stock selection, leading many investors to favor passive strategies that aim to replicate market performance. Additionally, passive funds typically offer lower expense ratios compared to actively managed funds, making them an attractive option for cost-conscious investors. To understand the potential market distortions caused by passive investing, it's essential to grasp how these funds operate. Passive funds aim to mirror the performance of a specific index, such as the S&P 500, by holding a portfolio of stocks that replicate the index's composition. This approach involves buying and holding securities in proportions that match their weightings in the index, with minimal trading activity. One concern is that as more capital flows into passive funds, the demand for stocks within major indexes increases, potentially inflating their prices regardless of individual company fundamentals. This phenomenon can lead to a feedback loop where rising stock prices attract more passive investment, further driving up valuations. Critics argue that this process distorts price discovery, the mechanism through which markets determine the fair value of assets, by decoupling stock prices from underlying economic realities. A notable consequence of the rise in passive investing is the increased concentration of capital in a limited number of large-cap stocks. As of November 2024, the top 10 companies in the S&P 500 account for over 35% of the index's total market capitalization. This concentration raises concerns about market efficiency and stability. For instance, the dominance of mega-cap technology companies, often referred to as the Magnificent Seven, including Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla, has led to their substantial influence over index performance. This concentration means that the performance of these few companies can disproportionately impact the returns of passive investors. Moreover, if these companies face downturns, the broader market could experience amplified volatility due to their significant weightings in major indexes. Legal and General Investment Management, the UK's largest fund group, has acknowledged these concerns. In October 2024, they announced plans to introduce caps on their new custom benchmarks to address investor apprehensions over concentration risks from large US tech companies. This move aims to mitigate the potential distortions caused by the heavy weighting of a few companies in major indexes. The shift towards passive investing also has implications for market liquidity and volatility. Passive funds typically engage in less frequent trading compared to active managers, which can reduce overall market liquidity. In times of market stress, this reduced liquidity may exacerbate price swings, as there are fewer active participants to absorb buying or selling pressures. Research from the European Central Bank in November 2024 indicates that passive investing may increase co-movement among stock returns, making markets more volatile. The ECB's analysis suggests that as passive investment strategies aim to achieve a benchmark return, their trading activity is not driven by stock fundamentals. To minimize tracking error, passive managers buy the whole basket of index constituents in response to fund inflows, selling in the case of outflows, and adjust their portfolios in line with changes to the index composition. This behavior can lead to increased correlation among stocks, reducing the benefits of diversification and potentially amplifying market volatility. Another dimension of the passive investing debate centers on corporate governance. The concentration of ownership among a few large passive fund managers grants them significant voting power in corporate decisions. As of late 2024, firms like BlackRock, Vanguard, and State Street collectively hold substantial stakes in numerous publicly traded companies. This concentration raises questions about how these entities exercise their voting rights and influence corporate policies. Critics argue that such concentration could lead to conflicts of interest or insufficient oversight, potentially allowing corporate management to act without adequate accountability. Conversely, proponents contend that large passive managers have the resources and incentives to engage in effective stewardship, promoting long-term value creation. Given these considerations, is it risky for individual investors to continue investing in index funds? The answer depends on various factors, including investment goals, time horizons, and risk tolerance. Passive funds offer several advantages that have driven their popularity. For one, they are cost-efficient. Passive funds generally have lower expense ratios compared to actively managed funds, allowing investors to retain a larger portion of their returns. They also provide broad diversification, offering exposure to a wide array of companies and sectors, which reduces the impact of individual stock volatility. Furthermore, passive investing requires less time and expertise, making it accessible to a broad range of investors. However, there are potential risks that cannot be ignored. Market concentration, as discussed, exposes investors to the potential downside of over-reliance on a few large-cap stocks. The reduced emphasis on price discovery may impair the market's ability to accurately price securities based on fundamentals, potentially leading to misallocations of capital. Finally, systemic risks emerge during periods of market stress. The uniform behavior of passive funds, such as simultaneous selling during a downturn, could exacerbate market instability. To address these risks, investors might consider strategies to balance their portfolios. Combining passive investments with actively managed funds or alternative asset classes, such as bonds, real estate, or international equities, can enhance diversification and resilience. Additionally, investors should remain vigilant about market trends and avoid overexposure to any single index or sector. Maintaining a long-term perspective and focusing on the fundamentals of investing, such as saving consistently, managing costs, and staying diversified, can mitigate many of the challenges posed by passive investing. Ultimately, the rise of passive investing is reshaping the financial landscape in profound ways. While it offers undeniable benefits, including cost savings and simplicity, its growing dominance raises important questions about market efficiency, risk, and the future of corporate governance. By staying informed and adapting strategies as needed, investors can navigate these changes effectively. If you enjoyed my analysis, please subscribe to my channel. Thank you, and see you next time. Remember, markets are unpredictable, and this content is for informational purposes only, not financial advice. Stay curious, stay diversified, and stay invested.